Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app.
That's what I'm talking about. Get your money right all in one app, peeps. Swizzle here. That, of course, Elizabeth Young-Thomas, she of SoFi, the aforementioned. This is Market Call Wednesday, November 20th. It's one of those weeks. By the way, in the lower right, as you're looking at the screen, you will see that our live subscriber count is now up to 92,659. It's like a Jerry Lewis telethon, Elizabeth. Do you remember those, by the way?
I do remember those.
I
am not too young for those. I do recall they sat in like tiered seats. It looked like a college classroom, and they had the windy cords, and but you know what I don't understand is why we were entertained by that. We would sit and watch this happen on TV. People answering phones.
You didn't have a lot of options back then. The world has changed considerably. But we do have some options today. As a matter of fact, what we also have, if it's Wednesday, it's Butters. Now, I've been saying it wrong for quite some time. Amanda corrected me earlier today. He is not the senior earnings insight analyst at FactSet. He's the vice president and senior earnings analyst at FactSet. So we have Butters today, which is always nice. But it's just the two of us because Dan, who flew home last night from Naples, Florida, is at a conference. I mean, we just got a lot going on.
Another conference? 2 in 1 week.
I mean, it's just crazy,
Making
right?
the rounds.
But let's throw the rundown up because Amanda's going to yell at me if we don't, and she made such a pretty one. Nvidia traders brace for a $300 billion move. Just for context, I think in the world, there are only about 45 or 50 companies that big in the first place. So just for perspective, Target misses the bullseye. That's so good. Look at that. Isn't that great? When we were kids, we had a game called Jarts. I don't know if you remember that. So Jarts were these I don't know how to even give you an example. They were like darts, but bigger darts with a big metal spike. And you would throw them across the lawn and try to get them into a round circle.
The amount of people that were,
no, it's extraordinary. Google it. And as I mentioned, FactSet's earnings insight and a little audience Q&A. So let's get right into it because, listen, I'm not looking to bury the lead. I mean, I think the market is bracing itself for better or for worse for what Nvidia says today. So let's just take a look at things real quickly because, that's the day. I mean, that's what everybody's been waiting for seemingly for the last few weeks.
Yeah, well, and I was trying to look under my microphone at my computer, and Nvidia at this moment in time is down 1.4% or so. I believe it was up in the pre-market. So we've had a reversal since then. And you know what? Who knows why? It's not like we can. Don't you wish sometimes you could send a message to investors in a certain stock and be like, why are you doing that? I wish we could understand it. Here's some speculation of maybe why. I mean, there's a ton of gains in this stock. We're approaching the end of the year. This is up again, 190% on the year. So here we are approaching the end of the year, last earnings report of the year. Maybe there are some investors saying, you know what, I don't want more volatility through the end of the year. I'm going to take some of my winnings. Maybe there's an anticipation that things will be a little softer than expected. And maybe there's just this kind of blowback from the fact that semiconductors have been weak for the last month or two leading into this report. And perhaps there's just rotation in the market, people taking money out. So I don't know. I don't know why this price move is happening today, but I will say it's pretty consistent with the rest of technology. So all of tech is pretty much down today. So this is not an Nvidia only phenomenon.
No doubt. And we're going to go to your note in a second, but I wanted to lead with Nvidia because, if you look at now our first slide, which is talking about Wells Fargo getting in the picture now in terms of price targets for the S&P, I think Wells Fargo just put a $6,600 price target for the end of 2025. Again, Carter will talk about this, and I know you're not one to do these things either, but obviously there are a lot of strategists or economists, whatever they are out on the street that do this. But if you think about it, and this might not be the most important quarter for Nvidia in terms of the company, but I think in terms of the stock and the stock market, it paints a much different picture. So you see this S&P that we've been talking about for a while. I think a lot of what's going to happen over the next couple of days, obviously, is predicated on what we hear. But it's interesting that, again, towards the end of the year, you start to see these parade of analysts. We talked about Brian Belsky earlier in the week. I think it was Mike Wilson at Morgan Stanley. I want to say Goldman Sachs got in on the act. So it's just a over and over, people sort of, I don't want to say tripping over themselves, but jacking up their price targets in the aforementioned S&P.
Yeah, well, and you know what's interesting? We talked about this a little bit on the tape on Monday. So far, these price targets are in a pretty tight range. I mean, Belsky at the top, but only 100 points above the next one down. So this tight range is only suggesting, let's call it a 10 to 12% move in 2025 in the S&P 500. The average total return annually in the S&P is about 10.5%. So all of these so far are coming in pretty much in line with what we would expect as an annual return on the broader market. If you dig deeper into it and go in and read all of these reports, Belsky's, for example, it gets really intricate about all the dispersion that he's expecting to happen. And I think that's consistent across the board so far with the outlooks that have come out. Also, we have to remember this would be year 3. If these price targets are accurate, if we have more upside in 2025, this would be year 3 of a bull market. And the first 2 years were pretty exceptional. We've got double-digit returns in the S&P. We've got certain industry groups, which we'll talk about in my note in a second, that have almost triple-digit returns for annual periods, which is outrageous. So in the third year of a bull market, things do tend to slow down a little bit, and you see more dispersion. Now, we've obviously seen the first 2 years of this bull market led by large cap stocks, which added to the narrative that we're late cycle, it's going to mature, everything's going to end at some point. And here we sit still, it's not over.
I said earlier that, in terms of the move, the expected move for Nvidia today is a $300 billion move. And I said it's probably about 40 or 45 companies in the world. As it turns out, it's about 30 companies. So you think about this for a second. Bank of America, for example, is a $350 billion company. So what we're talking about is Nvidia gaining or losing a Bank of America, a Salesforce, which is $300 billion. And, I think people become desensitized to the size of these moves, but more importantly, the size of these companies and just the import they have for the broader market. So I think context is important when you're in a day like today. So a lot is listen, I don't think we can overstate it. I think a lot of what's going to happen is predicated. And I think, you're starting to see some jockeying around. But let's go to your note, because it dovetails nicely with everything we've talked about for the last few minutes. This is semiconductors versus software. And I want to be crystal clear because I do pay attention. This is something that you were talking about earlier this year. And typically in our world, early is wrong. But, you were early and correct in terms of your thought that, software was going to start to catch a bid. And it might not mean that semis were going to get whacked, but it was probably going to be to a certain extent at the expense of semis. And that's what's been going on now for, I don't know, the last 5 or 6 months, but more importantly, for the last couple of weeks in a major way.
Yeah, so since the election, actually since November 8th in particular, we obviously had a couple days of euphoria after the election, but following that couple days, the market has had a hard time, and the market's had a hard time broadly with the S&P just kind of going sideways. But then you see certain things under the surface where the trajectory has completely changed, and semis versus software is one of those things. Now, I want to be clear. Yes, I have talked about this. My speculation and why I was starting to expect software to start to take over was because I didn't think people were ready to get out of the market, and certainly not ready to get out of technology. But you could feel that there was a sentiment shift, especially during earnings season, of some of these semiconductor names and of the really AI related names, in the sense that investors had gotten more critical of the spending that was going on, and they'd gotten more impatient about seeing results from all of this AI spending. So if they're going to start to pull back, or at least punish the stocks if they're not giving them a sufficient response or a sufficient explanation or sufficient profit that's actually happening already, they're going to pull back from maybe those names, but rotate into something else, into tech. This was my speculation. Rotate into something else in tech that could still produce similar growth. Because now as investors, we're used to this double-digit growth. We're used to double-digit earnings growth. We're used to double-digit stock market growth. So it's not as if people were going to rotate out of semiconductors and go buy something like Procter and Gamble, right? So looking for that commensurate growth, I figured that software would be the natural next spot to stop. I think that has happened to some degree. What I also think has happened is since the election, you've got a lot of companies that had said beforehand they were waiting to invest in bigger projects, to do big things, to make big moves, whatever the case may be, and perhaps even waiting to lock up their 2025 budgets until the election was over. So what you're seeing now, this criticism about all the AI spend, well, if companies are going to pull back on some of that spending and we're entering an environment where maybe growth is going to stay intact, that typically would mean they have more to spend on other stuff. And all of that AI spending had eaten into the spending on software. So now if they have more money left over, you get more spending in software. So that is part of what's gone on over the last couple of weeks.
No doubt about it.
Go ahead.
No, I was going to say real quick, not only that, but if you think about what we were dealing with prior to the CapEx for the longest time, and probably still happening right now, was going to AI related names. But not only was the CapEx going there, the investment dollars were going there as well.
That's right.
So
Yeah.
a lot of these software stocks were getting the sort of the double whammy of CapEx wasn't going to them and investment dollars weren't going either. And the stocks acted in kind. But the reversal, real quick, because I want to go to the next slide. But if Amanda can throw up like an Oracle chart, for example, I mean, you look at the move that this stock has had over the last few months. I think, as a matter of fact, if they didn't make an all-time high today, it made an all-time high within the last couple of days. I mean, Oracle has been unbelievable. And if you do longer term, just for perspective, I mean, this is not a biotech stock. I mean, this is Oracle, and it's been lower left, upper right for quite some time. That's Oracle. And if you look at what Salesforce has done, real quick, CRM, I mean, those are probably two of the bigger names in terms of the software side of things. Again, this stock, which had a big downdraft, you could see what happened into January of 2023, the subsequent move, and then the sell-off earlier this year. I mean, that's gotten back on its horse as well. So these were not working. They're working now. But your next slide, and, I want to talk about this. This has to do with earnings per share, the forward earnings per share. And I think this is really interesting.
Yeah. So the title of this section is called Earn and Burn.
Oh.
Which is obviously an ode to Top Gun. Anyway.
Yeah.
Okay, so earnings per share. This is for the fundamentalists out there. If you trade and you are basing your decisions solely on fundamental strength, you look at this chart and you say, well, obviously semiconductors should have outperformed. And they have by a wide margin. Year to date, semis are up 75%. Software is only up 14%. Okay, both of which are higher than what the market annually would produce. Last year, semis were up almost 100%. And this is just price return. But here's why. So this blue line is earnings per share for semiconductors. The magenta line is earnings per share for software. You can see that the blue line has widely surpassed the magenta line in the last year and a half or so. Not only is this the first time that you've seen it surpass and hold that, but this is by far the widest margin since this data set began. So if you're trading on fundamentals, you're looking at this and saying, obviously, semiconductors have been the better buy. There has been support under this as well. I'll also say about this chart, all of the comparisons that we make to the internet and the dot-com bubble and then subsequent bust, the argument that many people have for AI is that, yes, this is something that we're seeing similarly, enthusiasm has risen exponentially because of AI, but these companies have real earnings. And back in the internet bust, they didn't. So we're looking at that right here. Yes, they do have real earnings. Yes, they've gone up commensurately with the price action. So that is a good thing. But go on to the next chart. You can break down the price movement. And I've shown charts like this before, but this is specific to the semiconductor index. You can break down the price movement. The blue here is based on EPS. So that's the price movement this year on earnings growth. The pink section is the price movement that we would just call multiple expansion. So on other stuff, right? Usually intangible things, macro factors, sentiment, headlines, all kinds of stuff that can go into this. The reason that I want to highlight this is because, again, we've got semis up 75% this year. About 2/3 of that is due to earnings, which is good. But the other third of it is due to multiple expansion. And that's the part that's fragile. That's the part that's volatile. And you can look over history, and not even that long of history. Even in 2024, we have given up almost that entire pink section before during periods of volatility. So you want to be careful with expecting things to extrapolate out into the future.
What's fascinating about this, so just keep that visual real quick in terms of what Elizabeth just talked about. Now, let's take a look at some individual stocks, and I don't want Liz to opine because she doesn't do that. But for example, let's pull up a stock of Qualcomm, Amanda, if you could, and look at the move it's having today. By the way, this is on the heels of the last couple of weeks, which has been a disaster for Qualcomm. So, by the way, just for full disclosure, when they reported earnings a couple of weeks ago, I thought the earnings were such that it would take us to the June highs. That obviously didn't happen. We went right up to the 150-day moving average and failed. And now you're having another basically horrible day to the downside. This is not an insignificant stock for the SMH. So there's your one visual. You can see the huge support. Amanda can draw the line against the August 5th low, and you'll see we are right there, people. So keep that in mind. Let's go to the next one, AMD. AMD's obviously, they've had their own headlines over the last couple days, but this is a stock, again, that hasn't traded particularly well. It's been, every rally's been sold and can't get out of its own way. We're approaching that August 5th low, and I think that probably comes in around 125 or thereabouts. So keep that in mind. And the last one, and again, it's a little bit different, I get it, but Micron sort of falls into this world tangentially. 2 quarters ago, Micron reported a quarter that got the stock from 90 to about 118 or so. And I think collectively we're sort of looking at ourselves as that doesn't make a whole hell of a lot of sense. It was a fine quarter, but the valuation was such that I didn't think it was going to last. Now here we are sort of round tripping the whole thing. So 3 of the bigger companies in that sector are really having struggles. What's obviously holding the entire sector up, in large part, Nvidia, and in smaller part, TSM. But your point, if you go back to that with the magenta and how we can give up the magenta, that's why this whole thing, I think, is so perilous, in my opinion, Elizabeth.
Yeah. So the broader question that I was trying to answer in the note was, yes, semiconductors have far outperformed software, but can it continue? Based on fundamentals, if you look into 2025, earnings growth for semiconductors are still expected to be far above earnings growth for software companies. So that blue section should stay intact if things come in as we expect. But keeping in mind, a lot of that earnings growth expectation is still driven by Nvidia. And as long as that stays intact, again, the story stays intact. But the risk here is, number one, what if it doesn't stay intact? Then you've got a lot of price action that's happened on optimism that I think we've pulled forward a bit. The other thing is software companies, if the spending does move into software, then you've got a lot more optimism that can go in that direction. From a sentiment perspective, if we are in a market environment where people want more defensive exposure to tech, you're going to see software benefit from that. So given the fact that we've seen 2 amazing years in semiconductor performance and 2 okay years in software performance, I think it is time, number one, to manage risk in your semiconductor exposure, because positioning matters. So if you are now overweight semis because of this price action, it's time to manage risk. And you don't want to sleep on software. You want to have, I think, exposure to software going into 2025.
I love that you said don't sleep on that. That is a term that I use from time to time. And one thing we haven't been sleeping on, nice segue, Guy, is Walmart versus Target. And I don't want to show that chart yet, but let's just throw the Target chart up for today. And I apologize. I don't know, somebody's got a chainsaw outside. Maybe they're filming a movie. But this Target today is an unmitigated disaster. And, I'll just walk you through a couple things. Comps were not good. Average transactions, not good. Operating margins were 4.6%. The street was looking for 5.6%. Inventories were up to $15.1 billion. That's up almost 3% year over year against sales of about up 1% year over year. So what's going to wind up happening is they're going to have to guide down, which they did. Margins are going to continue to contract, which they are. And the stock market's going to punish them, which it is. And it's just a very unhealthy brew what's going on. And we learned a lot about Walmart yesterday. And if you could throw up the comp chart, Amanda, I mean, this is something, as much as I've gotten wrong, this is one we've gotten right. The outperformance of Walmart compared to Target continues to sort of diverge in a meaningful way. Now, at some point, valuations are going to come into play, and people want to say, Walmart now probably I don't know, twice the valuation of Target, might be getting ahead of itself, but that's been in place for a while. Now, the question I have to ask to you, and I think I sort of know the answer, is this Target specific, or do you think it makes more of a comment about the consumer?
I think that this in particular is more Target specific. I remember almost an identical thing happening a couple years ago. They had inventory issues, and it's always important to listen to these bellwether names, especially in a space like this. We've been listening very closely to Walmart, Costco, Target, Dollar General for some indication of, is the consumer pulling back? Where are they pulling back? We've been talking about this trade down story for a long time, all of which these companies should be a beneficiary of. But it still matters how you're managing margins, and it still matters how you're managing inventory. And just, in some of their defense, it's really tough to manage inventory in an environment where consumers can change their tastes very, very quickly. And I would even put Home Depot and Lowe's into this category too, because managing inventory for them can be tricky, especially in a housing market that continues to contend with mortgage rates that are all over the place. So I think so far, this is probably more Target specific, especially because the commentary that we've heard out of Walmart is completely different. Where you start to worry is when you're hearing similar trends out of all of those same companies. Consumers are spending less. We have way more inventory than we can unload. We're going to have to start discounting it. Those are the types of things that if you hear that from 2 or 3 of those big retailers at the same time, that's when it starts to be a trend that's showing up in the consumer.
Well, not to show you that I'm all negative all the time, Amanda, if you could throw up a chart of Williams-Sonoma, WSM, I mean, this speaks to the other side of the consumer, I guess, barbell. And again, I apologize for this. But Williams-Sonoma today making a new all-time high. Longer-term chart, you'll see exactly what I'm talking about. And again, it speaks to the health of one side of the consumer and then the other side of the equation struggling. And I think, if you want a clear picture of what's going on in the United States, I think it's crystal clear right here. And by the way, yesterday we learned from Walmart, and it's something I've been saying for a while, that now I think 75% of their customer base earns $100,000 or more. And, that's interesting for a number of different reasons. It speaks to $100,000 isn't what it used to be, and that's just true in terms of inflation. But it also speaks to people trading down to Walmart. And then on the other side of the equation, Williams-Sonoma just crushing it. And, I think that, and I hate the term, but I think that bifurcation and that chasm is going to last for quite some time.
Well, first of all, I'm a Williams-Sonoma shopper. I'm there quite often. I was just there a couple of weekends ago. And this is also a stock. Look, the store experience is nice. Okay. This is also a stock where it's going to benefit from holidays. It's going to benefit from the fact that they've got Christmas dishes out now. I haven't bought any yet, but I want to. It's going to benefit from all of that type of spending. And I think you're right. This is a big bifurcation in that market. But I also think that this is just something that consumers trend towards as the holidays come about. You always have to be careful about a gap that big in a chart. I don't have to tell you that, Guy. I know you know that. But I'd wait and see if this is really an indication that the upper end of the consumer spectrum continues to overspend or continues to do that much better. I think this is a little bit more niche of a market.
The XLY is one of those ETFs that I don't love the construction of it. 23% is Amazon, and I think almost 15% is Tesla. So you can do the math. Almost 40% of this ETF are 2 stocks. But throw up an XLY chart because you can see we're starting to roll over. And what's interesting, this is rolling over despite the fact that, Tesla's had a huge run and Amazon as well. So the question you have to ask here is, again, understanding, I don't love the constitution of this, but that little gap you see sort of between 205 and maybe 208 or so is probably in play. So keep an eye on this thing. And, this is one, by the way, if you go back and look, it always seems to do a mean reversion in terms of the 150-day moving average. And the fact that we're a couple standard deviations away suggests to me something's going to give on that. So it's either going to be in the form of Amazon or it's going to be in the form of Tesla, because quite frankly, those are the only 2 stocks that could have a move of that magnitude to the downside. So I just wanted to pull up XLY just to take a look. With that said, you know what time it is, Elizabeth. It's time for John Butters, the senior earnings analyst at FactSet. And today his note goes around exactly that, expected earnings growth. And if you look, analysts expect earnings growth of 12.1% for the fourth quarter. which is the highest growth we've had in 3 years. 6 sectors projected to report double-digit earnings growth for the fourth quarter. Financial and communication services. Those are things we've heard for a while. Banks and pharmaceuticals expected to be top contributors. That's, though, going to be interesting, Elizabeth, because we're seeing what's been going on with pharma. So you look at this, and it's sort of more of the same. You know, energy's on one side, financials and consumer services are on the other side. So it speaks to a lot of the things that you've been talking about as well. The expected earnings growth versus what is actually going to come out.
Yeah. So first of all, people might be looking at that Q4 number and saying, why such a big jump? I mean, you have to always remember the base effects. Look at Q4 2023 and even Q3 2023. We were coming off of what would be considered an earnings recession in Q1 and Q2 of 2023, and then pretty modest earnings growth in 3 and 4. So when you've got higher earnings growth compared to a year ago, you have to remember the base effects there. Look, I think the third quarter has come in much stronger than people expected. The fourth quarter, if we can pull off 12%, I think that'll be great. And it'll be a great way to start 2025 because we'll obviously hear about that in the beginning of 2025. But I think what's more interesting and maybe more important about this is the chart on the right-hand side and the sector makeup. So I will say it is nice not to see technology at the top of that chart because it starts to feel like we're relying way too much on a handful of names or relying way too much on one single sector to pull this off. And it is also nice to see financials in the lead because a cyclical sector, obviously something that matters so much for our economy. If financials do have the year that many are expecting in 2025 with increased capital markets activity, the fact that maybe rates are going to be lower, but not catastrophic, not going to cause too much damage, and just the fact that you've got these big money center banks benefiting from that activity and deregulation that people are expecting, that's a healthy market. You want to see those cyclical sectors take over. And we have asked for so long, can the market still go up without the Mag 7? Can the market still go up without large cap tech leading the way? And I think we're finding out that it can. It maybe doesn't go up at the same clip, but it can still survive.
And that leads us to a question from Gary Webb, and I think you sort of addressed it, but are we seeing down, and I'm reading, so I apologize. Are we seeing downward revisions to the fourth quarter EPS similar to what occurred over the course of the third quarter, beginning of the quarter, the time companies reported? You know, we're going to find out. It's going to be interesting to see. I mean, obviously, Target, you hear what they have to say, and that revision is staggering. And then the flip side of the coin is the Williams Sonoma. So to me, Gary, it's a bit of a mixed bag. I think we're going to know a lot more by the end of this week in terms of forecasts and stuff. And I think we're going to be able to connect the dots a lot better. But I will say this, I think earnings growth expectations are still wildly too enthusiastic, EY.
Well, and the other thing is that I want people to keep in mind, if earnings growth expectations are still high for 2025, but let's just play devil's advocate. Let's say they come true or maybe even beat on earnings growth. Let's say earnings growth comes in somewhere between 13 and 16%. Remember those price targets that people have put out already, only expecting about 10, 12, 13% growth. That means mathematically that the multiple compresses in 2025. Okay. So if you are of the mind that we are at a multiple that's way too high, let's say 23 times forward earnings, if you've got earnings growth that outpaces price growth, we're going to see multiple compression in 2025. That's going to be a confusing thing, I think, for investors to digest.
I think Jacob has a picture of the aforementioned charts. Jacob, if you want to throw it up, and or Amanda, you can see what I speak of. If you can't, you can sort of like leave me hanging, I'm sure. Here it comes. Those, Elizabeth, are now look at those. Do they look like weapons?
Those are
I mean,
dangerous.
that looks like something you drop from an effing plane, right?
Yeah, I'm guessing they don't sell these anymore.
No. You could probably get them on, like, what is that thing where you can, like, eBay or something, right?
Yeah.
But
eBay.
Mike Cole is asking, if you were to throw a chart at Nvidia up 5% or down 5%, what do you think? All right, and again, I'll be back tomorrow. So when I'm wrong, or if I'm wrong, I'll be the first to self-flagellate. But I think what's going to happen is they reported 420. I think the market's going to look at the headline number, going to get all excited. I think you're going to see a knee-jerk higher. And I think some of the commentary you might hear is not going to be up to the snuff that the market thinks. And I think you could see a reversal. So if you're asking me which you are, I think the first move is higher, and then I think we subsequently grind lower in the aftermath of the call. That's just me, EY. So we'll see how that plays out, but I'll be back tomorrow.
By the way, Michael Cole, if I have the person right, I may or may not. I think he's a big Packer fan. His picture on Twitter.
I believe so. I think you share that.
On a dog.
I think you share that.
Yeah.
By the way, if you look at that, your division, you have obviously the Detroit Lions, which is just kicking everybody's ass. I mean, kicking everybody's ass, right? You have the Minnesota Vikings playing decent football. The Bears suck, but then the Packers are playing well as well. So the NFC is dominated by 3 teams in your division. You should be feeling really good about yourself.
I feel pretty good about where we are this year, especially because I think expectations were low. So yeah, I'm loving this season.
But you see, what's interesting is Mike McCarthy, who was the Packers of Green Bay coach for quite some time.
Yes, he was.
He's come to Dallas, and he's an unmitigated disaster.
It's not going well. Yeah.
And Aaron Rodgers, who I believe was your quarterback for a period of time, has found his way to New York, and he sucks.
Yeah. So lesson learned: don't leave the Packers. Don't leave Green Bay.
Lesson learned. Here's a lesson for you. What do you think of Carson Block's of Muddy Waters talking about ELF? That came out. I saw that on the Squawk Box this morning. I think he said they're overstating earnings over the last couple of years by about $140 million or so. I have no view on ELF. It's been a great trading stock over the last couple of years. Amanda can throw a chart up if you'd like. I will say this about the work that Carson Block and Muddy, they typically do extraordinarily thoughtful work. So I'm not saying to short the stock. I'm not saying anything, but I didn't realize it's actually had a huge move lower over the last couple of months. I haven't looked at it in a while. So there you go. And if you can do a longer term chart, you'll see that there was a period of time where this stock seemingly was unstoppable, but recently it's obviously fallen on difficult times. So we're pretty much at those huge support levels. If you go back a couple of years, we'll see how it plays out. But I'll say this, his work is very thoughtful. Their work collectively is very thoughtful. Real quick, who's the last one? Oh, there's a poll we have on. Look at this. I didn't realize we have an Nvidia, we have a risk reversal media market poll. How will Nvidia shares react to earnings? Higher, lower, flat line. Oh, I love when we do polls. This is like fun. We're getting in all kinds of stuff. Throw that sucker up. Higher. We're not going to end the poll yet, but vote, people, vote. The other thing, by the way, just to sort of tie a bow on John Butters, you can see his work. Obviously, you can get it in your inbox if you like. We talk about it all the time. But we have something, and there you go. Subscribe to FactSet, factset.com/insight/subscribe. Not like yours, which is like dots and dashes. It's like friggin' Morse code. SoFi.com/on-the-money. I mean, that's a tough one. But as you say, Elizabeth, you can go to your website, and find it much easier.
Yes, you just click on investment strategy, which is me.
You don't sound enthused at all. We have something fun to tease, as they say. December 10th, 10 a.m. Eastern time. I want to say that's a Tuesday. I might be wrong. I don't know. It doesn't matter. It's December 10th. Transforming the financial landscape. AI's role in revolutionizing technology and workflows. It's a FactSet exclusive. Will be coming to you that morning. We're looking forward to that. Register for the webinar at riskreversal.com. And if you want to throw that bug in the bottom there, Amanda and or Timmy, we're approaching 93,000 on the YouTube page. We're looking to get to 100. So let's shoot up. They moved Elizabeth down there. Now they have the subscriber count. And
we haven't gotten any more subscribers during this show. I think that was
because everybody watching must be a subscriber. And then last but not least, it's not Amanda's vacuum for you wise guys. It's not my vacuum. It's some jackass out there with a leaf blower. I mean, it's crazy. So I apologize.
Well, I think this has been fun.
You don't. I sent Elizabeth a video earlier today that she actually laughed at. You did a LOL, as they say.
Well, he sent me his usual pep talk, which is just don't suck.
Yes, and then I sent a video.
Quite often, I hear those words from him
to accompany that, and you never do. I apologize for the leaf blower. We'll see you tomorrow. I think the great Carter Braxton Worth is with us. We'll have a lot to talk about. EY, you're the best. See you guys later.